Okay, it's reconstruction time for Hannah's Hobbies and Gifts. And so I imagine you probably find this a little bit daunting, having a blank shell here. But let's work through it, and hopefully with practice it should be sinking in. First things first, business name. Right, and I think what we'd probably do, what we'd benefit from, is referring to our other reconstructions that we did in part A. Could only be helpful to have them to refer to. Okay, so first things first, we're doing our receipts from accounts receivable. Okay, we're going to have our date in there, make that bold. And so we start with our opening balance. We add our sales. We take away any bad debts. There's no discount in this one, so we don't need to worry about it. And then in here we have our cash figure. Now, like the template, okay, the template that you've been using for most of your reconstructions has the guidance over here. I don't want to see that in the exam. You don't need to waste your time putting those bits and pieces in there. They are just there to help you as a guide as you are learning how to do this. I mean, it's up to you whether you do your reconstructions as you go or whether you want to set up the shells for all of them, because you might have crammed before the exam and need to just unload it and get it all out. Opening balance, and then we have our cost of goods sold. Yeah, and so what we're essentially working out is this figure here, and we're using, as I showed you in the first video, how we go about figuring out this figure. Okay, current inventory minus last year's inventory plus cost of goods sold. So this here requires the same numbers as well. Opening balance, and then just the 3 lines for inventory. Be consistent here. Accounts payable. Opening balance, and then our inventory control amount that we're going to take from up here. And then our cash figure. Okay, and so we've got those 3 reconstructions that we must do, and then we just have to do our account style reconstructions for our balance day adjustments. So in Hannah's Gifts, we've got 3 over here, so we want to add those in. So accrued revenue, so we want pretty much almost as it is here, is it? We want accrued revenue 1. Cash figure that we want, accrued revenue, F2, arrow to the end, save some typing, and then profit and loss. Accrued revenue, prepaid expense, make that bold, prepaid expense. expense year 1. Again, you might want to cut down on a bit of typing. You might go prepaid expense year 1. Don't do that. Copy. Cash. Prepaid expense year 2. And then profit and loss. So you can see there's a little bit of a pattern with these reconstructions. Might fix that. Like a bit of consistency in my text though, so if you have copied and pasted that, I wouldn't mind you fixing up your font there, but you know, when it comes down to marking it, am I going to mark that you have a different font in your reconstructions? Or am I going to mark you down? No. Accrued, that's just me being an anal accountant. Last one, accrued expenses. So we can go accrued expense year 1, copy, paste. Oh, sorry, I made a little boo-boo there. That's not meant to be prepaid expense, obviously. That's meant to be accrued expense. Pardon my typo. What are we doing here? Well, I better type this one then, hey. Accrued. F2, arrow to the end, year 2, and then profit and loss. Alright, make that bold. Alright, there's our shell. That's the way that I've chosen to approach it. Or you might just simply do them all as you go, depending on whether you think that you need to get all of this out first before you do anything. Alright, so accounts receivable reconstruction. Okay. At the end of the day, I don't think you should. The choice is yours. You can refer to this one here to build your numbers over here. I personally am going to go back to my balance sheet and income statement to do these and simply just check my amount over here. Okay, so our accounts receivable has an opening balance from the previous year of $400. Okay, our opening and closing balances still retain their normal nature. However, it's the in-betweens that we use to work backwards. So sales, okay, we're just using credit sales here because we're rebuilding accounts receivable. So our credit sales is $80,000. It's revenue. Revenue is normally a credit. So in this instance here, our sales will be $80,000 debit. Okay, working backwards. So therefore, debit and a debit, so equals 400 plus 80,000 gives us 80,400 debit. Okay, we've got our bad debts from our income statement. 332, bad debts is an expense. It's normally a debit. Working backwards, it's a credit here. Okay, so therefore equals 80,400 debit minus our 332 credit. Still gives us a debit balance. Okay, it's just decreased our debit balance. Then we're putting in our closing balance for accounts receivable, which is $700 debit. So in order to get from this figure to this figure, okay, quite a large credit amount. Okay, so we're going to be needing to use this box here, credit, so equals 80,000 minus 700, enter, gives us our 79,368 that we've got over here. Now, do you need to make that grey and everything like it's been in our examples? The choice is yours. You don't have to. I would like that, as a minimum, this amount to be bold, okay, in your exam. Alright, so that's accounts receivable. Hopefully that makes sense. Inventory control, we go to our balance sheet, we go to our assets, and inventory's opening balance year 1 is $500. Inventory being an asset is a debit. Again, our opening and closing balances still retain their original nature. Cost of goods sold from our income statement is $73,000. Cost of goods sold is an expense. Normal, regular nature is debit. So if we're working backwards, it's $73,000 credit. Okay, so we're swinging now from $500 debit to a credit amount because of this credit here. So equals 73,000 minus 500 gives us 72,500. And for those of you who are still a little bit stuck on that, typically we would go equals that minus that, but we end up with a negative number. Okay, and we don't want a negative. Our debits and our credits tell us whether something is positive or negative. So in order to end up with a positive figure that we can use our debits and our credits to tell us whether it's positive or negative, okay, 73,000 minus 500. Okay, and then our closing inventory balance is 1452, goes in here, and it's 1452 debit being an asset. Okay, so we need to figure out, we're going to swing from 72,500 credit to 1452 debit. Obviously we need quite a large debit amount to affect that change. Okay, so over in our debit column, we want to equals 72,500 plus 1452. We need to add them together to affect this swing from credit to debit. So 73,952 in our debit column, and we'll notice 73,952 marries up with our credit purchases over here. Okay, this figure here then carries down into our accounts payable. Essentially what we're doing with these two reconstructions here, we are determining all of this here. Okay, so this figure being a debit in inventory control comes down and is a credit in our accounts payable, so equals 73,952. Okay, accounts payable has an opening balance. We go to our balance sheet. Our liabilities has an opening balance of $300 credit. Okay, so then 300 credit, and then we've got 73,000 credit here, so equals 300 credit plus the next credit gives us that balance there. And then we want to use our closing accounts payable balance. Again, back to our balance sheet, we've got $750 credit. Okay, so our difference here, we're going from 74 credit to 750 credit. Okay, so obviously in order to affect that change, we need a fairly large debit figure. Okay, so we're going to be equals that minus that. Now, because we're not swinging from a credit to a debit, okay, we're not adding them together. They're still on the credit side, so we're simply subtracting that from that. 73,502 marries up with this figure over here. So far, so good. Alrighty, so that's those done, and now we need to deal with our balance day adjustments. Okie doke. So accrued revenue, back to our balance sheet. Accrued revenue in our assets, we have an opening balance of $25 debit. Okay, and remember our ending point that we want to end up with here is 0. So my strategy has always been to work backwards from here. Okay, so start from 0, and then as our narration tells us here, from the profit and loss, our we should really have accrued revenue accrued revenue interest. So our starting point, 0. Profit and loss interest, if we go back to our balance sheet, to our income statement, interest revenue is $220. That would normally be $220 credit. Okay, but however, to work backwards, it's going to be $220 debit. Alright. Get rid of that bold. $220 debit. Okay, so therefore, if we work backwards, in order to, this balance must have been $220 credit, because then if we check this, okay, $220 credit less $220 debit gives us a 0. Okay, so that's fine there. So our accrued revenue year 2, okay, working backwards, accrued revenue year 2, back to our balance sheet, is $50. It's an asset. It would typically be $50 debit. However, we're working backwards, so it's going to be $50 credit in here. So that must mean, okay, in order to arrive at a balance of $220 credit after a $50 credit, that means this balance must have been 220 minus 50 gives us 170 credit. Okay, so let's check this. 170 credit, add 50 credit gives us 220 credit, minus 220 debit gives us 0. So now what we need to do is just figure out, okay, what transaction will affect this change here from $25 debit to $170 credit. Obviously it's going to be a reasonably sized credit. And because we're swinging from debit to credit, we need to add these two figures together. So equals 170 plus 25 gives us 195. We can come over here, check this. Yep, $195 matches up. This is the figure that we're looking for. What's in our cash line. Okay, prepaid expense is insurance. Alright, so we start with our opening balance. Prepaid expense, insurance was 0. And our end point, again, is 0. Let's work out what went on in between. So for insurance, okay, our profit and loss amount, we go back to our profit and loss, or our income statement. Insurance, 1,300. 1,300 is an expense, so typically it would be a debit. Therefore, as we're working backwards, it's going to be 1,300 credit. Okay, so then this balance on the previous line must have been 1,300 debit. Okay, 1,300 debit minus 1,300 credit gives us this 0 balance. Alright, then our narration tells us prepaid expense year 2. If we go to our balance sheet, prepaid expense year 2 was $200. That prepaid expense is an asset, would typically be a debit. However, working backwards here, we're using the opposite nature, $200 credit. So if we're working backwards, $1,300 debit, and in order to get there, we had a $200 credit. So that means this balance here must have been 1,500 debit. Okay, we work backwards. 1,500 debit, less 200 credit gives us 1,300 debit, less 1,300 credit gives us 0. Therefore, the cash figure, in order to get from 0 to $1,500 debit, must have been equals, pretty simple, that minus that. $1,500 matches up over here. And notice by doing this as well, we arrive at, insurance is an expense. Okay, so the cash amount that we're looking for is is on the debit side. By working backwards, by using opposite natures through this, we still end up working out our expense amount with their correct nature. So insurance is a debit, interest, revenue is a credit. Just a trivial piece of information there for you that may or may not help you out on your journey here. Accrued expenses were wages. So okay, our accrued expense year 1 from our balance sheet is $80 credit. Okay, opening and closing balances retain their normal nature. Okay, so we've got $80 credit in there, but our endpoint is 0. So like we've done previously, we go back to our income statement, our profit and loss, our wages figure from our profit and loss statement or income statement was $24,000. $24,000 is expense, it's a debit. However, working backwards, we use the opposite nature here. Okay, so therefore this balance must have been $24,000 debit. 24,000 debit minus the credit gives us 0. Our accrued expense year 2 from our balance sheet down to our liabilities, $160. It's a liability. It would normally be a credit, but we're working backwards, so we put that 160 into debit. So in order to arrive at this balance after a $160 debit, means this figure here must have been less. So equals 24,000 minus the 160. Okay, and so again, if we work backwards or if we work down here, we want that to be debit. 23,840 debit, add 160 debit, gives us 24,000 debit, minus 24 credit, gives us 0. So now all we're doing is trying to figure out, okay, what transaction affects this change. We're swinging from credit to debit. So we will need to add these two figures together. In order to arrive at this figure, it will be a debit. Okay, to make a credit change to a debit, it's just going to be a large debit. So in our debit column equals 23,840 plus $80 gives us 23,920. We can come over here, we double check that those two figures marry up. Bold that, I'll make it grey. And there are our reconstructions. Simple, really, don't you think? Anyway, I hope that made sense, or makes a little bit more sense and helps you out on your journey in order to get this done and do well in your exam. How long's the video taken to record so far? Well, trying to get an idea of the first video was about half an hour. This one is much less. I've been talking you through it. So even with talking and getting this done and doing it from scratch has taken well under an hour. So hopefully with a bit of practice, you guys, you'll be able to do it reasonably quickly and also complete your theory questions with plenty of time to spare. Okay, that's enough from me. Over and out.